Hi ladies and gentlemen, this is Game of Trades, and I hope you guys enjoyed yesterday's video. As you know, we have a team of traders here at Game of Trades that are going to start putting out some bonus content on the channel. And today we're going to take a look at a very interesting trading strategy that I find absolutely fascinating, as well as a potential long trade idea in the markets. And I think that even if you are short in the markets, just like I am, it's always a good idea to hedge your shorts with potential long trades in the market. But before I let Gia take over, I want to say I'm going to be making an in-depth analysis of the S&P 500 as usual tomorrow, so make sure to tune in for that. There's lots of interesting things developing on the S&P 500. Now, without further ado, let's get right into it.
Hi, today we're going to introduce you to a different style, different methodology of interpreting the markets and price action using what we call the Riffle charts. Now, the Riffle charts are composed of two charts. We have a price chart up top with candlesticks, your basic 5 and 15 period moving averages, and the bottom chart is the stochastics. It's a momentum oscillator. So I pretty much view this as the roadmap and the engine. Now, before we get further into this, if you like what you've heard so far, feel free to hit the like button and subscribe so that you don't miss any of our new videos that are going to be coming out. So what we have here is the SPY, which is the S&P 500 ETF, and this is the daily chart. Now, when we look at the moving averages, we can see that the SPY is clearly in an uptrend. The stochastic has made its full oscillation up through the 80 band. Now, with the stochastic, the 20 band is considered oversold area, and the 80 band is considered overbought area. Now, once you get up through that 80 band, it's like an engine that's starting to redline. Okay. However, don't make the mistake of stepping in short too early, because gravity doesn't kick in until that 80 band actually slips. And then once it sells off and the oscillation comes back down, when it slips under the 20 band, it gets into the oversold territory. But once again, you don't want to step in too early while the stochastic is sitting under the 20 band, because as you can see here, it can stay under the 20 band for quite a duration of time. And the longer it stays under the 20 band, the deeper stocks or whatever the underlying trading instrument is continues to sell off, as we saw in the SPY here. So where we stand now is the daily SPY basically has busted up into an uptrend, gotten above the 80 band, and it is in overbought territory above the 80 band. All right. Now, the moving averages, we watch that 5-period moving average first, okay, because that's the first line of support, and the 15-period moving average is the laggard. And when the 5 crosses back down over through the 15 period, that's when the trend changes. As far as the daily is concerned, the 5-period moving average is now stalling here. So while this is still an uptrend, it is a dormant uptrend because the 5-period is moving flat, while the 15-period continues to rise and tighten the channel. What I also like to do is take a look at multiple time frames, kind of like how a weatherman will look at a Doppler radar. So we like to take a look at the daily, the weekly, and the monthly. When you hear about how a stock can be in an uptrend and a downtrend at the same time, it sort of makes you wonder, what is this guy talking about? Well, what we're referring to is you can have an uptrend like the daily SPY, an uptrend, okay, in the context of a wider downtrend. So think of it like a Doppler radar. The daily is like when you step outside of your house and it's sunny outside. You know, the weekly tells you that, maybe 90 miles away, there is a storm front. And then the monthly tells you that there is, there's a Durango setting up a major snowstorm, setting up, in the Mideast, and you're a couple states away, but you know it's coming. Okay, so when you look at it in that sense, when you interpret it in that sense, then the pieces start to fall together. So when we look at the SPY, even though the daily is looking to peak out and it's very tired, the weekly is still forming a stochastic oscillation up, and it's moving up through the 40 band. The monthly, however, stochastic has fallen down. Now, most of the times you're not going to get converge or confluence with all three time frames. When you do get the confluence in all three time frames, that's when you get a very powerful move. So the sell-off that we saw in the SPY that started basically February 20th happened when the daily stochastic coming down through the 80 band converged with the weekly stochastic slipping through the 80 band, with the monthly stochastic slipping through the 80 band. So literally a perfect storm to the downside caused literally a 34-35% sell-off in the SPY off the highs. So where do we go from here? We have a situation that's known as a make or break, where if the bulls are able to bust up through the 5-period moving average and cross the stochastic back up off the 80 band, in other words, they fend off the 80 band, they deflect it and cross it back up, then the SPY is pretty much headed back up towards this 1.618 fib area, the 291.18. And then we'll find a major resistance around the 295 area. Okay, so once again, this 291.81 is going to be your first line of major resistance. It is a 1.618 fib, and that is a PRZ, a potential price reversal zone, potential reversal zone. Okay, and then your 285 area, which is right at the weekly 15 level, or 295. Okay, so the 291.18, 295, that's where you're gonna get the move to the resistances on the wider time frames, and at that point we should see the SPY pretty much peak out and start to make its oscillation move back down. Now when that happens, think of it pretty much like a pinball game, and you've got bumpers. When you hit a bumper, you get a reaction. So this fib is a bumper. Each of these 5 and 15 period moving averages is a bumper. And when you have a wider time frame bumper, like a weekly or a monthly, those are stronger bumpers. And when they overlap with each other, all right, they're even stronger. So when you stack these bumpers on top of each other, you got to pay attention when they overlap at a with the wider time frame. So the 295 is the major resistance area to watch on the SPY, and then the 291.18 is your 618 fib. So that's the limit on the upside. Now on the downside, usually when we hit that 15-period bumper, then we take a move right back down to that 5-period moving average area. And the 5-period moving average is pretty much going to be close to that 275.50 fib by the 269.10. Okay, so 275 by 269. So that's pretty much the downside that we're looking at in the near term. Now, the stock we want to go over today is going to be DNKN, Dunkin. All right, so I'm sure a lot of you are familiar with this stock, Dunkin. It used to be called Dunkin' Donuts. It's an iconic brand serving coffee and donuts. This is a 100% franchise model, all right, meaning that they are asset light. So in times of pandemic, in times of crisis, it's really up to the franchise owners to keep their operations going. It is a royalty model, and because of this type of a model, most of their stores, at least around where I live, are open, compared to Starbucks, where most of their stores are closed. Okay, so right then and there, keep in mind, it already fits the narrative. And the narrative shapes sentiment, and sentiment is what shapes the price. So with the stay-at-home orders, the social distancing, and basically, governments closing down business, a lot of retail operations are closed. They're just simply closed. Starbucks being one of them. And Dunkin', however, like I said, their operations are still, operating for the most part. And because of that, they're already hitting the ground running, even to a point where I feel that they are maybe taking market share away from Starbucks. Now, Dunkin' came out with earnings, Q4 2019 earnings, a couple months back, and the main thing to remember with Dunkin' is that their espresso sales, believe it or not, 40% year-over-year growth, and espresso sales accounted for 10% of total sales. Their K-Cups grew more than 7%, outpacing Maxwell House and representing 8% of the total coffee category. Now, they have a loyalty program. They've got 13 million Dunkin' Perks loyalty members, which is a 38% year-over-year growth. Mobile orders grew 25% year-over-year, and half the Perks program members are using mobile ordering. And they're looking to open 200 to 250 new units by the end of 2020. And they also fit the upgrade narrative, because they are upgrading 500 stores a year to the next gen Dunkin' concept, which basically includes smart brewers, smart espresso machines, they're Wi-Fi enabled, basically Internet of Things type stuff where they're pulling oceans of data. They're more efficient machines. There's less waste, more productivity, easier to clean. They hold the calibration longer. So they're basically shoring up and they're harvesting efficiencies. All right. So like I said, Dunkin' is hitting the ground running. So as you start to see governments, states start to restart the economy, and it's starting. I mean, Georgia is already starting to open up businesses, starting with hair salons and gyms on the 24th. A lot of stay-at-home orders basically expire at the end of April or the first week in May, and there's a lot of pressure out there, a groundswell of people basically wanting to get back to work. Whether it's safe or not, that's not for me to judge, but the reality is economies are ready to restart. And so the narrative is going to be which companies are going to be hitting the ground running. Dunkin' is definitely one of them. Now, as far as watching for places to step in and buy, well, Dunkin', and when we look at the daily, it's already made a full oscillation. It is still very strong and trying to grind higher, but we don't like to pay retail. And the upper Bollinger Bands on the daily are basically pointing at the 64.47 area. So at 58.90, there's not a whole lot of upside. What we would rather see is areas to step in on a pullback. So once this stochastic peaks out on the daily, and keep in mind, earnings are coming out on April 30th. So no matter what, we want to wait and see what happens on earnings. Now, what's going to happen, narrative-wise, is if Dunkin' rises into that earnings period, the earnings report, the action could be a sell the news response, right? The price is already, it's already factored into the price, blah, 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 and you get a sell-off. Technically, I mean, that's what I would like to see, all right? I would love to see that, have the street find some way to poke holes in the story and then get a sell-off. Now, the question is, where should we look for on the sell-off? All right, so the key levels to watch is going to be this 54.89 fib, which overlaps with the weekly 5-period moving average, which is sloping up. So these are the buyers, the bidders. They're very patient, and they're sloping this thing up with a stochastic mini pup. A mini pup forms when the 5-period moving average tests and then deflects right off of there, which then forces or spring loads the stochastic back higher. All right, so the ideal spots that I want to watch for a pullback is going to be right here, this 54.89. Okay, 54.89. And then if for some reason this continues to sell off, then we want to watch for the 45.05 area right here. All right, and what this area is called a market structure low pattern. Trigger actually. So this is a very simple price action pattern where you measure lower lows. So on the weekly chart you can see a low, you can see a lower low, a lower low, a lowest low, and then a higher low. Now this higher low is about 2 cents higher than this low, but it is still a higher low. When you get that higher low, the high of that higher low candle, which we call a trigger candle, okay, you mark that, and that is 56.74 on the weekly market structure low. The daily market structure low is a 45.05. Okay, so that first entry level 54.89 is literally a stacked support area that we want to step in on the weekly market structure low trigger. And then the second area, the 45.05, that is your daily market structure low. So once again, the same thing. All right, you have a low, a lower low, a lower low, a lowest low, a higher low, and then the high of that higher low candle, the trigger candle right here, and that is our daily market structure low. And technically the buy trigger triggers there, and as you can see, it basically popped, tested one more time, and never looked back. So that is the area we want to watch for pullbacks as opportunistic entry levels on Dunkin. And the earnings come out April 30th, so we'll keep a close eye on that. All right, gang, once again, thank you for giving us the time and taking your time to look into the way we use a different lens to interpret the price action in the market. Feel free to subscribe, give us a like if you like what you see, and by all means, please put comments in there. We'll try to address any comments, and keep your powder dry, everyone, and thank you.